Good afternoon, everyone. Here's your market review. Starting with US dollar, the dollar index held steady even as the markets revived expectations of a December Fed rate cut. Atlanta Fed indicators point to a strong US growth, with GDP possibly rising from 3.8% in quarter 2 to about 4% in quarter 3, with official data due before Christmas. AI spending remains a key driver of US economic momentum. Deutsche Bank notes that without AI-related investment, private spending would look similar to 2019, and most commercial construction outside data centers has stalled. Bank of America expects tech giants to lift capex from $228 to about $344 billion by 2025, roughly 1% of the GDP, supporting the wealth effect and also consumer demand. Europe, meanwhile, continues to lag, especially Germany, where the business expectations remain weak. This contrast helps explain why the dollar stayed firm after earlier rate cut. When the Fed cut in September, updated projections showed fewer cuts ahead, which pushed the dollar higher. So a similar dynamic may occur in December if Powell cuts rates but signals a pause. So turning to crude oil, prices fell as geopolitical tensions eased. US-backed peace talks between Ukraine and Russia have moved into a more serious phase, with a revised 19-point proposal now on the table. Reports suggest Ukraine is open to the agreement, though details need to be finalized. So this development eased concerns about supply routes and also pushed oil lower. And technically, the energy markets remain in a downward trend. And finally, gold. Most of this year's gains have already been realized, but a Santa Claus rally into year-end is still possible as fund managers position for 2026. Weakness in the stock market, concerns about AI spending, and also rising political risk, including tariff discussions and the upcoming Supreme Court ruling, could give gold some additional support over the holiday period. So that's all for today's review. Thank you for listening.